The following podcast by Fusion Family Wealth, LLC, Fusion, is intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Please see additional important disclosure at the end of this podcast. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.
Hello, everybody, and welcome to another episode of the Fix It Friday edition of our Crazy Wealthy podcast. Today, I'm going to actually talk about one of the most destructive patterns in investing as it relates to a behavioral quirk, and that is the buy high, sell low, and repeat until broke strategy. Sounds absurd, but there's actually millions of investors who fall into this trap every year. So today I want to explore why this happens and hopefully give some contextual framework about how we can identify when it's happening to us and how to overcome it.
Welcome to the Crazy Wealthy Podcast with your host, Jonathan Blau. Whether you're just starting out or are an experienced investor, join Jonathan as he seeks to illuminate and demystify the complexities of making consistently rational financial decisions under conditions of uncertainty. He'll chat with professionals from the advice world, entrepreneurs, executives, and more to share fresh perspectives on making sound decisions that maximize your wealth. And now, here's your host.
First, I want to talk about the pathology. What causes investors to behave this way? And one of the key reasons is that investors conflate price of their investments with the value of the companies they're invested in. What I mean by that is when stock prices drop, and remember, stocks are just certificates that represent our ownership interest in a company, like an Apple computer or a Coca-Cola, much the same way that a deed evidences our ownership of a house. So when the price of the stock drops, investors somehow think that the long-term enduring value of whether it's Coca-Cola or Apple Computer is also dropping. And of course, that's not what happens. So price and value are two different things. And the way investors can start succeeding in terms of getting away from this buy high and sell low behavior is to stop thinking of their investments as investments in the stock market and instead think of their investments only as investments of the great companies of America and the world. That distinction is critical to make, and to start training ourselves to think in that way will absolutely help to break this pattern that we are almost all susceptible to at some point or other. So every year, on average, the S&P 500 has declined by about 15% since 1980. And every 5 years, we see a bear market, meaning a drop from a previous high in the market's level of at least 20%. The average bear market decline is about a third. So these are normal declines. There's nothing catastrophic about them. But when they happen, particularly when the declines I've seen in my career, and this is just from what I've seen, this is not empirical data that I studied, when we tend to go down below 25 or 30%, the real panic sets in. And unfortunately, by the time we're down that much, the decline is no longer discounting whatever the problem is. Let's say the pandemic or the economic shutdown in 2020. It's no longer discounting that problem. It's discounting mass panic and fear. And at that point, investors seem to throw in the towel, just at the point when the company prices, the stock prices, represent some of the best values that they can enter into these great companies at, in terms of ownership at low prices. And it's just at that point when investors want to sell low. And so what happens during euphoric markets, which is the opposite of panic, I always look at euphoria as the complete absence of an adult sense of fear. And so we just want to, at all costs, give in to envy, FOMO, fear of missing out, and chase whatever's going up. And when that happens, when people see others making more money than they make, they jump in and chase things that are already up 100 to 200%. And it's the same problem that causes these things. It's conflating price with value. So I'm going to step in for a second to two behavioral biases that also come into play with these behaviors. One is called loss aversion bias. It's proven that we dislike or feel the pain of a loss 2 times more than we feel an equivalent gain is pleasurable. And so what we do is we don't seek to maximize or engage in strategies that will maximize our long-term benefit, but that will minimize our chance for short-term loss. So that's a very powerful bias or tendency that we're just pre-wired to exhibit. And that certainly comes into play here with the buy high, sell low behavior. And then FOMO and envy. We chase what others have, especially and even when it's overpriced. And the reason we do it, I distinguish between envy and greed, because in reality, a lot of people want more things, bigger things, better things. But if you imagine yourself on a desert island where nobody else was around except you and your loved one, would you still want the Ferrari? Would you still want the big house? You probably wouldn't, because there's no such thing as wanting greater things in absolute terms. It's always in relative terms. We want a bigger thing because our neighbor has something bigger than we have. And once that disappears, we don't really care as much. So that's envy. That's not really greed, just wanting things for the sake of wanting them. We want things because we want to have the nicer, bigger thing than the other person we see has. Why not? We deserve it, right? So Warren Buffett, by the way, along these lines, has a great quote that I love. He says, people start being interested in something because it's going up, not because they understand it. But the guy next door who they know is dumber than they are, is getting rich and they aren't. I just love that quote because it's really what happens. There's another behavioral quirk that causes the buy high, sell low behavior, and that is the way we process economic and financial inputs. So in everyday life, with everything outside of investments, we process our economic inputs in a way that's called countercyclically. It just means we're attracted, our demand goes up when prices go down, counter. And conversely, our demand for goods and services goes down when prices are going up, right? Counter. And we behave that way with every economic and financial input except one. That's investments in general, and in particular, equities or stocks. When the price of stocks is high and rising, human nature believes that the opportunity to invest at higher prices for future gains is increasing, and that the risk of buying in at these higher prices is decreasing. Conversely, when the price of stocks is falling, human nature is repelled, thinks that the risk of buying in at these prices to great companies at lower prices that they can pay for the future earnings and asset growth somehow will yield lower returns, and the risk of doing so, buying at these lower prices, has increased. So, of course, reality isn't different than what human nature thinks in this regard. It's the opposite. Just think about it. Every year in this country, from Black Friday to Cyber Monday, everybody's spending record amounts of money, almost everybody. And are they doing it because prices have gone up during that weekend? No, of course not. They're doing it because things are on sale. But again, in just this one way, the price of stocks, people behave in the opposite direction. That counter-cyclical, what I call bias flip, is something that we need to be aware of, and we need to try to address it. And by being aware of it, and by thinking of companies instead of stocks, and understanding that when the market goes down 30% or so, if I have a problem with not conflating price and value, just simply take a ride in the car, go to Starbucks, buy a coffee, go into the mall, go to the Apple store, you take your bounty to quicker picker up, or mop up the spill, and understand that Procter and Gamble and Apple and Coca-Cola and my wife, I know, certainly shops at Amazon multiple times a day. I promise you that people don't stop doing that when the market's down 30%. And so keep those things in mind. Get in the car, do those things. It'll help you to become more rational about the frequent, sometimes steep, but always temporary declines in the prices of the great companies that we own. What we need to do at the end of the day, it is a mechanical way to address this behavior as well. It's a portfolio management strategy. It's called rebalancing. So, for example, in our portfolios, we may have, just as an example, 5 offsetting investment options. So within the equity markets, it might be small company exposure large company, domestic, international, and then value as a style versus growth. There's two different major styles. And if each of the five represents initially 20% of my exposure, but one of them disproportionately skyrockets in price for whatever reason, it's gotten much more expensive, and the other ones are now selling at a sale, what we do is we rebalance. We take that one that's gone up 40% and we kick some of it out of the portfolio, and we take advantage of the sale prices of the other four, and then we rebalance to our prescribed targets that we set out with. Remember, people's plans, exposures shouldn't change unless their goals change. We shouldn't change our plans in response to envy or fear. We should never move our portfolio in response to market dislocations, politics, geopolitics, or anything else that we hear on the news that might move us to want to do that. It's human nature. It's okay to be afraid. It's okay to feel envy, but it's never okay for an investor who wants to succeed in the long term to respond to those emotions by changing their portfolio in response. So hopefully this podcast has been helpful in helping you address the buy high and sell low behavior that many of us exhibit, if not always often. And with that, thanks for tuning in today, and look forward to seeing you on the next episode of Fix It Friday. You can catch us on Apple, Spotify, YouTube, and all of your favorite venues, as well as our crazywealthypodcast.com website and our fusionfamilywealth.com website.
Thank you for tuning in to another episode of the Crazy Wealthy Podcast. For more insights, resources, and to sign up for our newsletter, visit crazywealthypodcast.com. Until then, stay crazy wealthy.
The previous podcast by Fusion Family Wealth, LLC, Fusion, was intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation. Neither Fusion's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Fusion is engaged or continues to be engaged to provide investment advisory services. Fusion is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the video content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Fusion is engaged or continues to be engaged to provide investment advisory services. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.